A portfolio can say 60-40 on the label. It can still behave like one big interest rate bet. That is the sharp idea in Martin Leibowitz's 1986 Financial Analysts Journal paper, Total Portfolio Duration. Everyone knew bonds had duration. Duration is the rough number of years that tells you how sensitive a bond is to interest rates. If a bond has duration 5, then a 1 percentage point rise in yields can mean about a 5% price loss before income and convexity. That is not perfect, but it is useful. It gives the first slope. Leibowitz asked a stranger question. Do stocks have duration too? Not in the clean bond sense. A stock has no maturity date. Its cash flows are uncertain. Its price responds to earnings, inflation, real rates, growth hopes, and fear. Still, stocks often move when rates move. So if a stock portfolio moves with bonds and bonds move with rates, then stocks may carry effective rate exposure. That is the hidden risk. The pie chart says stocks and bonds. The duration gauge may say one combined instrument. Now imagine a pension plan in 1986. It owns stocks for growth. It owns bonds for income and stability. It also owes future benefit payments to retirees. Those promised payments behave like a long bond liability. When interest rates fall, the present value of the liability rises. So the sponsor does not only care whether the assets make money, the sponsor cares about surplus. Surplus means assets minus liabilities. If assets rise less than liabilities when rates fall, the plan gets weaker. If assets fall too much when rates rise, the plan also gets hurt. The real question is not, what is our stock weight? The real question is, how does our whole surplus move when interest rates move? Traditional asset allocation gave a simple answer. 60% stocks, 40% bonds. That answer was neat, but it was incomplete. The bond sleeve has duration, the liability has duration, and the stock sleeve may have effective duration. Leibowitz wanted one gauge that combined them. He called it total portfolio duration. Here is the worked example. The paper used the S&P 500 as the stock market. It used a broad Salomon Brothers bond index as the bond market. The key historical window was January 1980 through November 1985. First, Leibowitz estimated the duration of the bond market against changes in 10-year Treasury yields. The bond market duration came out near 4.27 years. Second, he looked at how the S&P 500 moved against the same yield changes. That relationship implied a stock market duration near 2.19 years. That number surprised people. Earlier dividend discount model logic could make equity duration look extremely long, sometimes 20 years or more. But Leibowitz was not asking how long theoretical cash flows lasted. He was asking how the market actually moved with rates. The empirical stock duration was much shorter. Now put the pieces together. Bond duration is 4.27. Effective stock duration is 2.19. The portfolio is 40% bonds and 60% stocks. Total duration equals 40% times 4.27 plus 60% times 2.19. The answer is about 3.02 years. Pause on that. If you looked only at the bond sleeve, you might say the portfolio has 40% times 4.27 or 1.71 years of duration. But that misses the stock sleeve. Once stocks are included, the total duration is closer to 3.02. The portfolio did not change. The measurement changed. The pie chart stayed 60-40. The duration gauge moved. The simple classroom formula is this. Stock duration equals stock-bond correlation times stock volatility divided by bond volatility times bond duration. In plain English, correlation opens the door. Volatility changes the size of the exposure. Bond duration translates that exposure into rate sensitivity. This is why a modest stock-bond correlation can still matter. Stocks are usually more volatile than bonds, so a small link to bonds can become a visible link to interest rates. Then the portfolio formula is even simpler. Portfolio duration equals bond weight times bond duration plus stock weight times stock beta times stock duration. In Leibowitz's example, stock beta is 1. So the stock sleeve contributes 60% times 2.19. The bond sleeve contributes 40% times 4.27. Together they give 3.02. This is the paper's core lesson. The stock-bond mix is not the same thing as the portfolio's rate exposure. It helps to see the mistake in two columns. In the left column is the visible allocation. 60% stocks, 40% bonds. That is what the investment committee sees. It is what the policy statement records. It is what most performance reports show. In the right column is the effective rate allocation. The bond sleeve contributes about 1.71 years of duration. The stock sleeve contributes about 1.31 years. Add them, and the portfolio has about 3.02 years. The right column does not replace the left column. It explains one hidden behavior inside it. A manager can have the same visible allocation and a different hidden rate profile. For example, keep the same 60% stock weight. Keep the same 40% bond weight. Now shorten the bond portfolio. The total duration falls. Or lengthen the bond portfolio. The total duration rises. Or keep the bonds the same, but assume stocks stop moving with bonds. The stock duration contribution shrinks. That is the practical power of Leibowitz's frame. It separates the policy mix from the risk mechanism. The policy mix says what assets are owned. The mechanism says which economic force can move them together. The same 60-40 portfolio can have different total duration in different regimes. Why? Because correlation changes. When stocks and bonds are independent, stocks add little to total duration. When stocks and bonds move together, stocks add more. At high positive correlations, adding more equities can even raise total duration instead of lowering it. That is deeply unintuitive. Most people think bonds are the interest rate asset and stocks are the growth asset. Leibowitz showed that the line can blur. The reason is not mystical. A stock price is the present value of future cash flows. Rates help set the discount rate for those cash flows. If the discount rate rises and expected growth does not rise enough to offset it, equity prices can fall. But stocks are not pure discount rate instruments. Inflation can raise nominal revenues. Strong growth can lift earnings. Risk appetite can change valuation multiples. So equity duration is not one clean number in the way a treasury bond duration is. It is an empirical summary of a messy relationship. That is why the paper's measure 2.19 years is best read as an estimate for that historical environment, not a law of nature. Now connect this to liabilities. A pension liability also has duration. If the liability duration is long and the asset duration is short, falling rates can hurt the funded status. The liability rises more than the assets. If the asset duration is too high, rising rates can hurt the asset side too much. The surplus is the object that matters, assets minus liabilities. The slope of that surplus with respect to interest rates depends on the mismatch between asset duration and liability duration. If they roughly match, the surplus is closer to immunized against small rate moves. If they do not match, the plan is making a rate bet. Sometimes that bet is intended. Often it is accidental. That is why this paper mattered. It moved asset allocation from a pie chart toward asset liability management. The manager has more than one decision. Choose the equity weight, choose the bond weight, choose the duration of the bond sleeve, then ask what duration the total fund has after equity rate sensitivity is included. A 40% bond allocation is not one thing. It can be short duration bonds. It can be intermediate bonds. It can be long bonds. And each choice can create a different total fund duration. This is where the paper becomes practical. If a fund needs more rate sensitivity, it might not need more bonds. It might need longer duration bonds. If a fund needs less rate sensitivity, it might not need fewer bonds. It might need shorter duration bonds, or a different equity mix, or a different hedge. The old question was, how much should we own in stocks? The better question is, what risk are we trying to match? There is a catch. Equity duration is an estimate. It is not stamped on the stock certificate. It depends on the history you measure. It depends on the rate benchmark. It depends on stock volatility, bond volatility, and stock-bond correlation. And correlation is not stable. In some decades, stocks and bonds diversify each other well. In other periods, inflation shocks can push both down at the same time. That is why total portfolio duration should never be treated as a permanent label. It is a live diagnostic. The wrong use of the paper is to say our equity duration is exactly 2.19 forever. The right use is to say our stocks may carry rate exposure, so we should measure it, stress it, and update it. The paper is also clear about scope. Total duration is one risk measure. It is not the whole risk system. Equity earnings shocks matter. Credit spreads matter. Inflation surprises matter. Liquidity matters. Market psychology matters. Duration gives the first rate slope, not the full weather report. But the first slope can matter most when rates move a lot. That is what made the idea durable. It gave investors a better question during rate shocks. If yields move 100 basis points, what happens to the whole portfolio? And what happens to the liability the portfolio is meant to fund? That question still matters. Think about 2022. Many investors thought stocks and bonds were separate buckets. Then inflation rose, rates jumped, and both buckets fell. The pie chart said diversified. The duration gauge said exposed. That does not mean Leibowitz predicted every detail of 2022. It means his diagnostic was built for exactly this kind of surprise. When the same macro shock represses stocks and bonds together, a stock-bond allocation can become less diversified than it looks. The chart has two colors. The risk has one driver. A duration view asks whether that driver is interest rates. If it is, the investor can choose a response. Use shorter bonds, use longer bonds, hedge rates directly, hold more cash, change the liability benchmark, or accept the exposure because the expected return is worth it. The key is not that there is one correct answer. The key is that the exposure becomes visible. Leibowitz gave us the language for that moment decades earlier. A balanced portfolio is not just a blend of asset classes. It is a blend of sensitivities. The visible allocation is only the starting point. The hidden allocation is to interest rate risk, growth risk, inflation risk, and liability risk. Total portfolio duration isolates one of those hidden allocations. It asks whether the whole fund rises or falls when rates move. For a retiree, that can affect spending safety. For an insurer, it can affect capital strength. For a pension, it can affect funded status. For an endowment, it can affect how much stress shows up when rates reprice every asset at once. The takeaway is simple. Leibowitz showed that stocks can carry effective duration through their co-movement with bonds. That means a 60-40 portfolio may have one combined interest rate sensitivity, not just a bond sleeve duration. The practical move is to measure the whole portfolio, compare it with the liability or spending need, and stress the correlation assumption. Never assume that only the bond sleeve is exposed to rates. The pie chart tells you what you own. The duration gauge tells you one way it can break.